€40,000 a year, without working, from dividends alone. But there is a trap in that number that costs most people years. I will show you exactly what it is at the end of this episode. That number requires exactly €1 million in invested assets. Not 10 million, not 100 million, one. And here's what nobody tells you about getting there. Mike Petrie has made this his public goal on Nobody Told Mike. This episode is the technical breakdown, the math, the ETF types, and how to build a dividend portfolio from any starting point. Nobody Told Mike tells the stories. Here we break down the numbers. Before building a dividend portfolio, you need to understand one calculation. It is the foundation of every decision that follows. Dividend yield is the annual dividend payment expressed as a percentage of the fund's price. A fund priced at €100 that pays €4 per year in dividends has a 4% yield. The income equation is simple. Portfolio value multiplied by dividend yield equals annual income. At 4% yield, €1 million. That is the number. Mike Petrie's target on Nobody Told Mike. But the yield changes the target, and this is where most people get it wrong. At 3% yield, you need €1,300,000 to generate $40,000 per year. At 4% yield, you need exactly €1 million. At 5% yield, you need €800,000. The higher the yield, the smaller the portfolio you need, but the higher the risk. Funds with very high dividend yields often hold companies under financial stress, cutting dividends or reducing payouts over time. Chasing the highest yield frequently destroys the income it promises. The sustainable zone for a long-term dividend portfolio is 3 to 5%. Mike Petrie's target of 4% sits at the center of that range, deliberately. Chapter 1. 3 types of dividend. ETFs. Not all dividend ETFs are the same. There are 3 distinct types, each with a different yield, a different growth profile, and a different role in a dividend income portfolio. All ETF names mentioned are examples only, not recommendations. Always verify current fees, yield, and structure before buying. Type 1. High dividend yield. ETFs. These funds own companies selected specifically for paying above-average dividends right now. The current yield is the priority. Income today, not income growth. Typical yield, 3 to 5%. European UCITS examples. VHYD, the Vanguard FTSE All-World High Dividend. Yield UCITS ETF. IDVY, the iShares. Euro Dividend UCITS ETF. US equivalents are shown on screen for reference. This is the core engine of a dividend income portfolio. Mike's current 10% dividend ETF allocation in his EP03 portfolio sits here. VHYD as the primary position. Type 2. Dividend Growth ETFs. These funds own companies with a strong track record of growing their dividends year after year. Not the highest yield today, but a reliably increasing yield over time. Typical current yield, 1.5 to 3%, lower than high yield. The payoff is in the growth. European UCITS examples. VDPX, the Vanguard Dividend Appreciation, UCITS ETF.US. Equivalents are shown on screen for reference. Dividend growth ETFs suit investors still in the accumulation phase, building toward the income stage, not yet drawing from it. Type 3. Dividend Aristocrat ETFs. These funds own companies that have grown their dividends consecutively for at least 10 to 25 years, companies that maintained and grew dividends through the 2008 financial crisis, the 2020 COVID crash, and every market event between. Typical yield, 2 to 3.5%. Lower than high yield, but the consistency is exceptional. European UCITS examples. VDPX covers significant overlap with the Dividend Aristocrat universe. US equivalents are shown on screen for reference. Chapter 2. Building the Dividend Layer. Over time, the dividend portfolio is not built in a single transaction. It is built in stages, the same stages covered in Episode 6 of What NTM Told Us. In Stage 1 and Stage 2, the accumulation phase, Dividend ETFs play a small role. The priority is growth, but even a 5 or 10% allocation to VHYD in Stage 2 begins the habit of dividend reinvestment, the process of directing dividend payments back into the portfolio rather than withdrawing them. In the accumulation phase, dividend ETFs should ideally be distributing. They pay dividends out, but those dividends are immediately reinvested manually or through a broker auto reinvestment feature. The psychological value is real. Seeing actual cash dividends arrive, even small amounts, reinforces the long-term behavior of staying invested. Here is a confession. Most people, Mike Petrie included, get this wrong for years. The instinct is to withdraw the dividends when they arrive. They feel like income. They feel earned. Taking them feels natural. But in the accumulation phase, withdrawing dividends is the single most expensive mistake a dividend investor makes. Every euro withdrawn is a euro that stops compounding. Nobody told us that. Now you know. As the portfolio moves through Stage 3 toward 1 million euros, the dividend allocation increases. Mike's EP03 portfolio holds 10% in dividend ETFs, plus 10% in individual dividend stocks. That 20% dividend income layer is already generating real income. Not yet enough to live on, but enough to reinvest and compound. At Stage 4, the income phase, the dividend allocation reaches 40% or more. The reinvestment stops. The dividends are withdrawn as income. The portfolio becomes self-sustaining. If the dividend income framework is making sense, hit like. It helps more people find exactly this kind of passive income breakdown. Chapter 3. Mike's Dividend Income Calculation. Here is how to live off dividends, applied to Mike Petrie's real goal on Nobody Told Mike. Target, 1 million euros in invested assets. Target yield, 4%. Annual income, 40,000 euros. Monthly income, 3,300 euros. At Mike's current Stage 3 portfolio, let us assume for example purposes a portfolio of 300,000 euros. The dividend income layer at 20% is 60,000 euros in dividend-generating assets. At 4% yield on that 60,000, 2,400 euros per year in dividends. 200 euros per month. Not enough to live on, but compounding rapidly. And the growth ETFs, the other 80% of the portfolio, are building the total value toward 1 million euros. As the portfolio grows, the dividend layer grows with it. At 500,000 euros with 20% in dividend assets, 4,000 euros per year in income. At the 1 million target with 40% in dividend assets, 16,000 euros per year from the dividend ETFs alone, with the remainder from individual dividend stocks reaching the 40,000 euro annual target. The math works. It just requires time and the right structure, built in stages, held through market cycles, rebalanced annually. Living off dividends is not a myth. It is a calculation and a portfolio built to match it. The dividend income portfolio has 3 tools: high-yield ETFs for income now, dividend growth ETFs for income that increases over time, and dividend aristocrat ETFs for income that has survived every market crisis in living memory. Mike Petrie's approach on Nobody Told Mike is to build the dividend layer gradually, 20% now, growing toward 40% as the 1 million euro target approaches. The growth ETFs build the portfolio. The dividend ETFs build the income engine. They run in parallel until the destination is reached. That is what Mike Petrie calls modern financial philosophy. Not the highest yield, not the flashiest fund. The right structure, built in the right order, held for the right duration. The tools were always available. Nobody explained how to use them together. Now, the trap I mentioned at the start. The trap is this. Most people see their dividend ETF paying 3 or 4% and decide to shift everything into dividend income early, before the portfolio is large enough to sustain them. They sell their growth ETFs. They chase yield. They lock in an income that sounds like 40,000 euros a year, but on a portfolio worth 300,000 euros generates 12,000. Nowhere near enough to live on. They traded the engine that builds the portfolio for the engine that runs on it, too early. The result is a portfolio that can never reach the size it needed to be. The sequence matters. Growth first, income later. In that order, always. Here's the question for the comments. What annual dividend income would make you feel financially independent, and how far are you from it right now? Be honest. If this breakdown clicked for you, subscribe here for more NTM explainers, and watch Mike explain the full portfolio strategy himself. Nobody told Mike. Link below.